FAR.F5.M4. Partnerships.
Jenna, partnership accounting feels like one business with several owners keeping separate scoreboards.
That's the right mental picture, Russell. The partnership owns one pool of assets and liabilities, but each partner has an individual capital account. That account tracks the partner's claim on the partnership's net assets.
So, one pizza, several slices.
Useful, but imperfect. A partner's capital balance does not necessarily equal that partner's profit and loss percentage. Capital reflects contributions, withdrawals, and allocations over time. The profit and loss ratio tells us how specific income or loss items are divided.
Good distinction. Capital percentage, ownership percentage, and profit sharing percentage might match, but the exam does not promise that they will.
Exactly. Keep them separate unless the facts connect them.
Let's begin with admitting a partner. The first question is whether the new partner buys an interest from an existing partner or contributes assets directly to the partnership.
If the new partner purchases an existing partner's interest, the transaction is generally between those two people. The partnership receives no new cash or other assets.
So, even if the new partner pays a dramatic amount, the partnership usually records no new asset.
Right, the partnership generally changes the name attached to the transferred capital account. Total partnership assets, liabilities, and capital remain unchanged.
That's a major trap. The problem gives you a purchase price and your hands start reaching for a cash entry.
Ask where the cash went. If it went directly to the selling partner, it never entered the partnership's books.
Now suppose the incoming partner contributes assets to the partnership itself.
Then the partnership records the assets contributed at fair value. Liabilities assumed are recorded at their present value. The incoming partner's capital equals the fair value of assets contributed minus the present value of liabilities assumed.
And the textbook contrasts that with the tax rule, which uses the contributor's net book value.
Correct. For financial accounting, remember fair value. For tax, remember net book value. Do not blend the two.
Once the contribution goes into the partnership, we may use the exact method, bonus method, or goodwill method.
And the fastest way to lose points is to start calculating before identifying the method.
Under the exact method, the incoming partner's capital equals the actual contribution. No goodwill and no bonus.
The common question is how much the new partner must contribute to obtain a stated percentage of the partnership's total capital after admission.
That last phrase matters. After admission.
Yes. Suppose the existing partners have total capital of $80,000 and the new partner wants 20%. The contribution is not simply 20% of $80,000 because the contribution increases the total capital.
It's like trying to fill 20% of a swimming pool while your own water is also making the pool deeper.
The analogy works because the denominator changes. You solve for a contribution that equals 20% of the new total capital.
So, the exact method is a target problem. Find the contribution that makes the incoming partner's capital percentage come out exactly right.
That is the pass key. Exact method questions usually ask how much the new partner must contribute. No bonus or goodwill is required to make the arrangement work.
Now the bonus method. Here, total recorded capital controls the capital allocation.
Correct. Add the old partner's capital to the incoming partner's actual contribution. That gives total partnership capital after admission. Then calculate the incoming partner's agreed capital interest.
Suppose total capital after the contribution is $100,000 and the incoming partner receives a 30% capital interest. The new partner's capital account should be $30,000.
Now compare that $30,000 with the actual contribution. If the new partner contributed more than $30,000, the excess is a bonus to the existing partners.
Because the new partner put in more value than the capital account received.
Exactly. If the new partner contributed less than $30,000 but still receives $30,000 of capital, the old partners transferred part of their capital to the new partner.
So, new partner pays more than recorded capital, bonus to old partners. New partner pays less than recorded capital, bonus to the new partner.
That direction is heavily tested because it's easy to reverse.
I picture theater tickets. If I pay $40 and receive a $30 ticket, the extra value benefits the people already inside. If I pay $20 and receive a $30 ticket, someone already inside gave up value for me.
Good analogy. Just remember that no new intangible asset is created. The bonus method reallocates capital among partners.
That gives us the passkey. B for bonus, and the balance in total capital accounts controls the allocation.
Exactly.
Now goodwill. This method says the incoming contribution reveals that the partnership may be worth more than the recorded net assets.
Under the goodwill method, the incoming partner's contribution and ownership percentage imply the total value of the partnership.
If the incoming partner pays $30,000 for 20%, the implied total partnership value is $150,000.
Then compare that implied value with the partnership's recorded net assets after the contribution. The excess is goodwill.
And that goodwill is generally allocated to the existing partners using their old profit and loss ratio because the value existed before the new partner arrived.
Correct. The incoming payment exposed previously unrecorded value.
So G for goodwill means the going and investment dollars control the calculation.
That is the passkey. Under goodwill, the contribution and percentage tell you the implied whole. Under bonus, recorded total capital controls. Under exact, the incoming partner's capital equals the contribution, and you solve for the required amount.
Let me compress it. Exact asks how much must the new partner contribute. Bonus asks how should recorded capital be shifted. Goodwill asks what total value is implied by the incoming investment.
That is the module's most useful three-part comparison.
Now let's divide profit and loss. This is where salary allowances, interest allowances, and bonuses show up.
The key point is that these are methods of allocating partnership income. They are not ordinary expenses in the way employee salaries or bank interest would be.
So, a salary allowance is not saying the partner is an employee. It is saying that partner receives a designated portion before the remaining profit or loss is divided.
Exactly. Follow the partnership agreement. A common sequence is salary allowances, interest on capital, partner bonuses, and then division of the remaining amount using the residual profit and loss ratio.
What if the allowances exceed total partnership income?
Then the remainder is negative. That residual loss is allocated according to the stated residual ratio.
So, a partner can receive a salary allowance and still end up with a modest total allocation after absorbing part of the residual loss.
Yes. These allowances are steps in the allocation, not necessarily guaranteed payments beyond total income.
And if there is no partnership agreement?
Partners share profits and losses equally, regardless of their capital balances.
That sounds odd enough to remember. One partner might have contributed much more capital, yet profits are still shared equally if the agreement is silent.
Correct. Also remember that the partnership can use different ratios for different items. One ratio may apply to ordinary income, another to gains, and another to withdrawals. Never assume one ratio controls everything.
Now a partner leaves. Withdrawal accounting again uses either the bonus method or the goodwill method.
Under the bonus method, compare the withdrawing partner's capital balance with the amount paid. The difference is allocated among the remaining partners according to their relative profit and loss ratios.
If the departing partner receives more cash than the capital balance, the remaining partners give up capital.
Yes. If the departing partner receives less than the capital balance, the remaining partners receive the benefit.
And assets may first be adjusted to fair value if the problem requires it.
Right. That adjustment is allocated to all partners before the withdrawal is recorded.
Under the goodwill method, the payment to the departing partner may imply that the partnership is worth more than the books show.
Then goodwill is recorded and allocated among all partners. After that adjustment, the withdrawing partner's capital account should equal the amount paid.
Same contrast as admission. Bonus transfers capital. Goodwill adds an intangible asset.
Exactly.
Now, liquidation, where the partnership converts everything to cash and settles the scoreboards.
The general process is to sell non-cash assets, recognize gains or losses, pay liabilities, and distribute the remaining cash to partners based on their final capital balances.
Creditors come before partners' capital claims.
Yes, including partners who are creditors. A loan payable to a partner is a creditor claim. The partner's capital account is an ownership claim and comes later.
That distinction feels like one person wearing two hats.
Good analogy. The creditor hat gets paid before the owner hat.
Any gain or loss from selling partnership assets is allocated to the partners using the applicable profit and loss ratio.
And those losses can create capital deficiencies. A capital deficiency means the partner has a debit capital balance and owes money to the partnership.
If that partner also has a loan receivable from the partnership, the right of offset may apply.
Correct. The partnership can offset the loan balance against the capital deficiency rather than paying cash out and demanding cash back.
What if the deficient partner cannot pay?
The remaining partners absorb the unpaid deficiency according to their relative profit and loss ratios.
Relative means we recalculate using only the partners who remain.
Exactly. If the remaining partners' original ratios were 60% and 30%, while the insolvent partner had 10%, the two remaining partners absorb the deficiency in a 2-to-1 relationship.
Liquidation schedules also require caution before distributing cash.
All possible losses must be considered before cash is distributed. The partnership should not pay a partner too early and later discover that the partner's capital was needed to absorb additional losses.
The textbook's passkey puts that in practical language. The partners most vulnerable to shortages are paid last, while partners with stronger capital positions may receive safe payments earlier.
Right. Multiple choice questions often ask which partner can safely receive cash and how much. The goal is to preserve enough capital to absorb potential losses and creditor claims.
Let's close with the full mental map. One partnership owns the assets, but each partner has a separate capital account.
When a partner enters, first ask whether the transaction is between partners or with the partnership. A purchase from an existing partner usually does not change total partnership assets or capital. A direct contribution does.
Then identify the method. Exact means solve for the contribution. Bonus means recorded total capital controls. Goodwill means the incoming investment implies total partnership value.
For profit and loss, follow the agreement and treat salaries, interest, and bonuses as allocation steps. Capital balances do not automatically determine the profit-sharing ratio.
For withdrawals, bonus shifts capital, while goodwill records previously unrecognized value.
And for liquidation, sell assets, allocate gains and losses, pay creditors first, resolve capital deficiencies, and distribute only safe remaining cash.
So the best question throughout this module is, did value enter or leave the partnership, or did it merely move between partners?
That question separates purchases from contributions, bonuses from goodwill, and creditor claims from capital claims.
And it keeps the pizza slices from quietly changing size while nobody is watching.
You held on to that analogy all the way through liquidation, Russell.
Unlike a capital deficient partner, it survived.